The market doesn't know what keeps you up at night. It doesn't know when you want to retire, and it doesn't know how old you are. The simple truth is, the market doesn't care. But if you care, you've tuned into the right place. You're listening to Investor Resources, bringing clarity to the confusing world of finance. Here are your hosts of Investor Resources, Don Creech and Perry Sykes.
Well, Happy New Year. This is Don Creech.
And this is Perry Sykes, and welcome to the Investor Resources Podcast.
So we are going to take a quick look back at this last year and try and figure out what on earth we should be expecting for next year, because last year's forecast in January or late December, I think we could say was basically 100% wrong, no matter where you look. There are very few who got it right. Because as we came into the year, just think about what was on our table of issues to worry about. We had a recession that was inevitably going to come because of high inflation and rising interest rates. Interest rates had risen to about 4.5%, and they were going higher as the Fed continued to reassure. Higher for longer was the story that we should be paying attention to. In March, because of higher interest rates, we had three major banks collapse, and the fear at that time was, this is just the beginning. Remember the great financial collapse in 07 and 8 and 9? This looks like
here we go again.
Here we go again. And then as we went through the year, consumers continued to spend, and their savings balances were dwindling. How on earth can the economy continue if people run out of money? And then we had property collapse, commercial real estate particularly. Housing prices not so much, but housing sales were falling, and housing sales are a major driver for economic growth in our country. So without housing sales, the assumption is the economy must slow down. And then we had the war, and then that leads to an energy shortage, a crisis. And it turns out that inflation, as we entered the year, was 6%. Now it was down from 9%. So that was an optimistic benefit. But at 6%, that's still substantially higher than we're used to. And in the last couple of decades,
the Fed said they weren't stopping at 6. They weren't even considering slowing down at 6%. They were heading for 2.
Then you turn around and you take a look at what was going on in the market. My goodness, the things that were down, they weren't down just a tiny, tiny bit. They were down big time.
Huge, especially on the tech side. Yeah. The big tech guys, they were just getting pounded. The Qs, the NASDAQ 100 was off 54% in 2022, and coming into 2023, Meta, Facebook off 68%. Nvidia and Amazon were both down 55%. Google was over 40% below its high, all in the first quarter of 2023. So things were not just looking bad, it was terrible out there. It really was horrible, especially coming from those mega tech stocks, because that's where all the growth was coming from, and they were just getting hammered.
Well, and the inflation news certainly didn't look good.
Things had terrible.
So the assumption was that maybe we're going to get a soft landing, and it won't be real bad. It raises the question of, why would anybody be wishing for a recession?
It's true.
With recession, you get unemployment, loss of income, spending goes down. There's nothing normally good that happens in a recession, other than the Fed is forced to lower interest rates to re-stimulate the economy. But if they did that, it would also cause a resurgent inflation. This was the damned if you do and damned if you don't scenario that we moved into.
Yep.
But Mr. Market decided that a soft landing was possible, and the market began to go up until it didn't. And then about August, and then we got this big sell-off that took us into October.
Right.
And all of a sudden, things look differently, and there's a resurging price in both stocks and bonds because the market is saying the Fed is going to have a recession. They'll have to lower interest rates. The Fed is not supposed to be a political animal. They assure us frequently that politics are not their game.
Not their thing, yeah.
But
they repeatedly show that it is. They're of course influenced by the economy and what's going on inside the Beltway all the time. And last year was just the same old story about don't listen to what the Fed says, only watch what the Fed does. They can be very different things.
Well, as Mr. Powell came up to the end of his term, he needs to be reappointed in order to stay on the Federal Reserve Board. He was consistently saying inflation was transitory. There's no problem here. This is going to go away. It's not a problem. When he got reappointed within a couple of weeks, we need to raise interest rates. Certainly job security would have had no impact on the data that they were looking at. But interest rates began to rise. And interestingly enough, here at the tail end of last year, 23, we're looking at things where we're being told in the media that things are improving. Inflation is coming down. But at year end, from the St. Louis Fed, consumer prices are still up 17% since the presidential election. Gas prices are up 28% since the presidential election. Credit card debt is up 40% since the presidential election. Real hourly wages are down almost 3%. None of this sounds like a particularly good story. And mortgage rates are a full 4 percentage points higher. They're no longer 2.5 or 3. They've been above 7 and now are above 6, a little below 7. None of these things would seem to make any sense for easing off. But
no.
Just coincidentally, one of the year-end presidential approval polls came in with a really negative number. And in 2 weeks, the Fed went from higher for longer regarding interest rates to, oh, we can cut them. So the real problem is higher for longer for inflation seems to be a more likely scenario. Even the Bureau of Economic Analysis has data that they just recently released, expecting inflation in the coming year to be higher than it is at the end of December.
Right.
So we have a scenario for the stock market that prices are rising in the Santa Claus rally, or the rally that started in October. We've got a couple days in January for the Santa Claus rally, and then the question is, do we have enough momentum to move forward without a big sell-off? I personally think the answer is yes. I think we have a bull market in the year, but given the recent run, we could have January with a pretty normal pullback in prices.
Sure.
That wouldn't be a surprise.
But things are like you said, things are looking fairly good. It just depends on the data as it comes out, and if inflation reignites, and the Fed has to back off their 2 to 3 cuts, and they're not going to get there. That's not going to make the stock market happy. There's not going to be a huge positive response to even rates not coming down, even if there's not another rate increase, which would be a tough sell unless things really got worse. But inflation has surprised us before, and we never know where that's going until it gets here. It's another one of those data points that you really have to wait for it to come out before you really know how is this looking. And then, of course, it's going to get revised a couple of times because those numbers are always heavily massaged before they're released. And sometimes it can take a quarter or two to get to where we really are. And it's going to take a while, but we are set up much better now for a year of recovery than we were last summer, when it was really looking, this could go either way. We really could be looking at a recession, and now it's a little harder. It's a little harder to get there, anticipating what's coming up, and hopefully it runs that way. Hopefully we do have a year of recovery, and things can continue to grow this year.
Well, at the end of the month, and of course this is the end of the quarter, we send out an update to the trustees for whom we manage 401k plans, and that employee correspondence that we provide. My last sentence in there is that the health of the market this year is really dependent upon the Fed's decision to cut interest rates. Because what you just said is, if they don't cut interest rates, it's really hard to support a market that is seeking brand new highs. The Dow accomplished an all-time high in late December. The S&P is really close to that. The NASDAQ has much further to go. But the NASDAQ is interesting because it's really challenged with the development of who's going to benefit from artificial intelligence applications.
Correct.
Who can integrate this into production or to personnel, to products? How is that going to work? And those newer, smaller companies are the ones that are going to get the biggest bang out of that AI development. Who comes up with the quickest and fastest way to generate profits on the bottom line? And it's the big benefit for the majors is already over. It's the introduction and making available the technology. So NVIDIA, being the provider of the chips, it has a pretty decent outlook because it's demand driven for a product that's only available through them for the time being.
They don't care who's successful. Whoever it is has got to buy their chips. So they're
right.
They're in the catbird seat. They really do have they're like the people who were selling shovels during the gold rush. They don't care who finds the gold. Just keep buying the shovels. That's where NVIDIA is. They're going to be in good shape. So
Microsoft's doing well too, because they are expanding the use of that through their platform of products. And so those two companies seem to be the ones that are leading as far as majors are concerned. But we have to remember what happened with the introduction of the personal computer back in the 80s. And the guy who dropped out of college and set up business in his dad's garage in Seattle by the name of Bill Gates introduced DOS, the DOS operating system. And IBM wanted to buy it from him, and he said no. He licensed it to them. But IBM didn't think that personal computers had any particular market. Who on earth would need a computer on their desk? And,
what a waste of time,
Microsoft knocked them off their pedestal and is certainly much larger than IBM. IBM's never climbed back up on top of that pedestal. We're in a technology transition right now. It's very similar to that with AI. It's the same kind of revolution that Bill Gates' DOS brought to computing, that AI is bringing to not just technology as an industry, but the entire business world, whether it's healthcare or automobiles, aircraft. Well, you think of an industry that has to produce something and produce it efficiently. AI is going to be the tool that moves us past the current level of production into a totally new one that we really are having a hard time figuring out where this is going to go.
Yep, absolutely. And like you said, you inferred earlier, Don, there's going to be some small companies that end up with some disruptive entries into the technology world that are going to change things so quickly that they're going to become immediately successful, and they're just going to blow up. And unfortunately, for the most part, there's no way to see that coming. There's no way to know who is going to actually get that traction, but it's going to be some of those more innovative firms that aren't so large that they can't change everything they're doing. The ones that can stop and change direction, some of those are going to be some big winners, and it's going to come from left field. It's going to be just a lightning strike, and that's going to be exciting to see.
it's going to disrupt labor, and we already
Yeah,
see the fear of that in the negotiations by unions with the auto
sure.
industry and with the movie industry. We've had those, they've concluded them,
Yeah,
and their big fear is that AI is going to replace their workers, and what are they going to do? Then the union is fearful that it will lose power if it has even less workers than it well, it has less workers than it did a couple of decades ago by a big margin.
right.
And they see AI as being an even bigger threat going forward. So we have to stay tuned and watch and wait and look for where that revolution is popping up its head.
And roll through. Yep.
The number of industries that are affected here is huge. It's bigger than we could list. I had a list of them that I was reading through this weekend, and it took a couple of pages of scrolling through my monitor to get to all of
Right.
them, because there's about 140 industries inside the 11 major sectors, and each of them stand to benefit. So stay tuned, pay attention, watch the data, be careful with what you bet on. This year is going to be an extension of change in the markets. You want to keep abreast, subscribe to our podcast. I think that's a wrap for today.